Hello, everyone. Thank you for joining today's webinar. As always, I'm Mitch Michigan, a partner at Fifth Era. As you all know, Fifth Era is an investment firm that invests in funds and companies, specifically around blockchain and AI. And you may have seen many presentations from me in the past on the topic of tokenization. So rather than another presentation from me today, we're actually joined by an expert in the field, and that's David Alamany, and we're going to have a relatively short 30 to 40-minute conversation, which will get posted online afterwards. So any questions you have, you can put into the chat. But David is someone I've known for a long time. We were roommates actually back in university, and he's gone on to do a lot of things, consultant, business school. So David, thanks for joining, and why don't you just give a very short introduction?
Absolutely. Thanks for having me, Mitch. So I'm on the investment team at 1KX. I joined around 10 months ago, and I'm pretty much covering everything from real world assets, stablecoins, DeFi, payments, anything in those categories, really. As Mitch mentioned, we went to Wash U together, but I have more of a traditional finance background. So after undergrad, worked at KPMG for about 5 years, was a management consultant on their financial services team before realizing that consulting was not in my long-term career plans. At that point, applied to business school, ended up going to Columbia. But there's also when I fell down the crypto rabbit hole. It was around DeFi summer 2020, and I was obsessed, spending all of my time on chain. I carried this interest into business school. So my first year, I launched an on-chain fund. It was focused on lending, staking, looping, liquidity providing. And then after I graduated business school, spent a couple of years in investment banking on the digital assets team at Keefe, Bruyette and Woods, before realizing that I wanted to get back into the early stage crypto space. So that's what led me to 1KX.
Yeah, I mean, just amazing background. And KBW's blockchain team is, super well renowned within the space. And Dave and I have that in common that we both went the investment banking route. And we brought David on here today because he's written a pretty in-depth thesis on real-world assets on chain, aka tokenization, as we call it. There's a lot of different names for it, and maybe Dave could talk about the nuances. And before we get into that, obviously, for many of you who followed our firm, tokenization is absolutely, critical to our blockchain thesis. We believe that all of the world's assets, monies, and commodities are moving on chain, and Matthew and Allison have been saying that for about 10 years. And before we get into this, I should say, full disclosure, Fifth Era is an LP in I think a few of 1KX's funds. So none of this is investment advice. We're going to talk about maybe different companies where we have exposure and biases. So I just want to put that out there that this is just a conversation. But before we get into tokenization, real world assets, Dave, maybe just talk very big picture. What drew you to crypto, decentralized networks, blockchain in the first place?
Absolutely. It's a good question. So, during college, people had started to speak widely about the price of Bitcoin. At that time, it was like increasing at a rapid rate. And I never really thought much of it. When we first started working, I maybe bought a little bit of Ethereum and Bitcoin, but never really gave it much thought. And then really during 2018, 2019 is when I started to do a deep dive and try and learn as much as possible about it. And that's when I kind of became obsessed. It was a convergence of many different factors, but it aligned with my ethos. I was just fascinated by the programmable, borderless nature of crypto technology, blockchain technology. And yeah, it was just fun. There was a big community aspect of it. And the more time I spent in this space, the more I continued to learn about all the different areas. And, it became clear that this was the career or the industry that I wanted to pursue.
And I think what you touched on, I think it's very same to similar for me. I was very drawn to this idea of disintermediation, which I know is really core to your thesis, right? Basically taking
Absolutely.
out intermediaries, aka financial institutions, bank, custody providers, and we'll get into it in your thesis. And I just want to put a pin in this because I think at the end we'll come back to it. But I think that sort of anti-system decentralization, let's say, dream that was there at the start, I think is very juxtaposed with where the market is now. As we see, it's gotten very, let's say, investment banker like Suits, BlackRock, Morgan Stanley are both on the board of our portfolio company, which went public on New York Stock Exchange this week, Securitize, which we'll talk about. So I think we should come back to that because there's a little bit of it's kind of interesting how you know the way this is moving is very institutional, which is obviously very good as an investor, but how it relates to those initial, let's say, decentralized anti-system interests, I think is quite interesting.
Yeah.
So let's hop into your thesis a little bit, but maybe just very high picture again. I think a lot of people on here have seen Fifth Era's content, know what tokenization is, but for those people on the line or maybe people who are joining late, give us the 101. What do you mean tokenization? What is real world assets? How do you place these different terms in relation to, what you do at 1KX?
Yeah, no, so it's funny. Well, so at 1KX, my main focus so far has been, I'm pretty much covering three areas right now. So tokenization stack itself, so the infrastructure that's bringing real world assets on chain. And then within that stack, we're kind of focused on the neutral layers. So compliance, data and oracles, issuance mostly. We think those are the rails that every institution has to use and that no one incumbent can own. So that's kind of the core of the thesis that I published recently. The second one is DeFi as a distribution channel. So we think tokenized treasuries and credit as they come on chain, the venues that can put those assets to work as collateral, as yield, as building blocks are going to gain more than the venues that just list them. And that's not the listing of the assets is not necessarily a defensible position. I've been spending a lot of time on-chain asset management, lending, credit infrastructure as well. And then the third, I'd say, is stable coins and the payment layer underneath everything. So obviously, like stable coins are the cash leg of tokenized markets. So the banking, payments, settlement infrastructure around them touches everything else that we look at. So if tokenized assets are the merchandise, I'd say that stable coins are the money and that you need both of them for this trade to work. So those are probably the three overarching themes that tie together to make tokenization real world assets feasible on chain.
Yeah. And maybe I'll just restate it without some of the, intellectual jargon. That was quite a great answer. But, tokenization, I think most simply is basically representing something as a token on a blockchain, right? So basically, you have Bitcoin, you have Ethereum. These are native crypto monies that travel instantaneously, programmably, anywhere with an internet connection, right? And are built on distributed ledger systems, meaning that it's not governed by one central party. So what tokenization can do is take things from the real world, aka stocks, bonds, dollars, money markets, and now we're going to represent that on a blockchain so that, in some instances, the only, record of that asset and who owns it and where it is actually maybe on a public blockchain or a permission blockchain or various blockchains. So I think, it's basically, it's just the underlying infrastructure that allows us to bring real world assets on chain. And that leads me to my next question, which is, again, maybe just high level. Why should, people on the line, 1KX's LPs, regular people, like, why should they care about this idea of tokenization of real world assets?
Yeah, no, that it's a very good question. And yeah, I agree. I think your explanation of what tokenization is in a very easy to understandable way was very on point. But yeah, just to like reiterate, basically every bank and broker keeps its own private list of who owns what. So when you buy a stock, a whole chain of companies has to update their separate lists and check those lists against each other, which is why a trade takes a full business day to settle and why there's a fee every step along the way. But basically, tokenization replaces all those separate lists with just one shared record. It's the difference between five people emailing spreadsheets back and forth and everyone working in the same shared document. And once there's a single record that everyone trusts, transfers can happen in seconds at any hour of the day. You no longer need a room full of people whose job is checking that those lists match. And then in terms of like why an average person should care about tokenization, I'd say that there's like a few different reasons. So the first is access. So someone in Lagos or Jakarta, for example, who wants to buy US treasuries or blue chip stocks today, has to go through correspondent banks, currency controls, local brokers that often don't even carry the product that they're seeking. With the tokenized version, all they need is a phone, a minimum investment can be a few dollars, and there are currently over 350,000 wallets that are holding tokenized stocks today. And most of them belong to people who could have never bought those shares through a broker in their home country. I'd say a second is time. So markets are open 6.5 hours a day, 5 days a week, but people's lives don't run on exchange hours, and the news doesn't either. So tokenized markets, they stay open around the clock. So you can trade on a Sunday night the same way that you already shop or spend money on a Sunday night. So there really isn't any difference on that front. And then lastly, I'd say cost is a big factor. So while doing my research, I came across a report from the Bank of International Settlements. They released a really good study, and it found that the industry spends between 17 and $24 billion every year just processing trades. And that expense ultimately gets passed down to anyone who's transacting. So if tokenization can shrink that number, the savings will show up over time as cheaper products and better returns for regular investors.
Yeah, very well stated. And I think, again, for everyone, 1KX has put out this thesis. David's made a post on LinkedIn, and your opening tagline, absolutely love. So I'm just going to read it here. And it says, everything we back at 1KX comes down to one question. What does it cost two parties who don't fully trust each other to transact? And who keeps the margin that cost creates? And I think that's just such a beautiful thing because really just from first principles, trust is actually a technology, right? If I'm, going and one of the ways that we had trust, up until now was by bureaucracy, right? By institutions. That bank is essentially a trust mechanism. So two people who don't know each other, I'm taking in deposits, the bank's loaning it out. Effectively, it's connecting two people on opposite ends of a transaction and taking that fee. And so I absolutely love that positioning because what blockchains do is instead of having an institution affect that trust, is that we do it with software, right? And so I think that's the most fascinating idea in the way that you guys put that. I really, really love it. And then obviously on top of that, once it's software, well, now we can do all these really interesting and cool things, right? Automatically. And so I think the most simple way to say, why should you care about this is that all of those different bureaucracies and institutions along the chain of a transaction that you're paying essentially to trust, well, you have to pay them, right? So there's fees along the whole stack. So it's just cheaper. It's cheaper, it's better, it's more efficient.
Exactly.
Um, so
Enablement and disintermediation, the two things.
yeah, so I think that was really, really well said. Um, So I guess one thing that I found interesting in the thesis is that you don't argue that today's financial system is completely broken, right? I think that maybe that's a little bit different, right? I think if Matthew, our founder, were here, he would say current financial system's broken, it's costly, it's slow, it's analog. You take a much more, I would say, maybe it's a bit more nuanced view that it's just built for a different era.
Sure.
Maybe just explain what you meant by that a little bit. The current financial system versus a blockchain-based, real world asset one.
Absolutely. No, it's a really good question. And yeah, I'd say during my thesis, I wanted to take a measured take and look on this. A lot of crypto native people will say, oh, like the old system, burn it to the ground, put everything on crypto rails. But I didn't necessarily think that that's the case. Um, so yeah, it's complicated. So I'd say it's more than a trend. Most of these middlemen will exist to check separate records against each other, and
Yeah.
but if you put the asset on a shared ledger, the reconciliation work doesn't disappear. The settlement will drop from a full business day to a few seconds. Markets can stay open around the clock. There's an underrated one, which matters in the long run. Once issuing an asset becomes cheap enough, whole categories that were never worth the paperwork, like small business receivables, will become economical to bring on chain. Um,
I mean,
and
one thing I would just interject there, and I think you're kind of, maybe just to double click. I think that there is, and you brought up in your first statement, there is this divide, I think, emerging economy versus developing economy or developed economy, right? And I think that, for it is true. I think we have to be honest as investors in the space that for the average person in London, I live in London, you live in New York, you go buy a cup of coffee, you have your Apple Pay, you have, it has your Visa logged into it. The system works reasonably well,
yeah,
right? The dollar is your reserve currency. There hasn't been historic devaluations. So, and when I came out with some of our original presentations, I always said that I thought that in those parts of the world, the transition would be driven by the institutions because when you're talking about Visa taking a few percentage points, bip here, bip there, it's really at the scale that that savings really matters. You contrast that with the emerging markets, exactly as you've said, capital controls, average, transfer fees of 7 to 15%. We're invested in a company called Yellow Card, which I know you're aware of that. I've had Chris on here before. Chris Maurice, the CEO. They basically help facilitate stablecoin payments in Africa and Asia and other emerging economies, Latin America. And in these countries, it's really, really salient. So the friction of the financial system is much more in your face, right? Average inflation in Argentina in the last 50 years has been 200% per year, average.
Yeah.
So it's a much different thing. So was that part of it was a long-winded way of kind of going on a little bit of a digression. Was that part of when you say um that like basically when you're saying it's not broken, are you kind of talking
Yeah.
along those dividing lines?
Yeah, so I'm saying it's not broken. Like if you're a US institution today and you're buying a large liquid US stock during market hours, the system works beautifully and it's like hard to beat. And I think that's worth saying clearly because the case for tokenization doesn't really depend on us claiming otherwise. But where it shows its age is like kind of at the edges. So markets are closed most of the time, even though extended hours trading is already more than 11% of US equity volume. And foreign investors already own more than like 20% of US equities. And they're oftentimes awake exactly when our markets are shut. Trades still take a full business day to settle, which traps margin, adds risk to our system. And basically, investing across borders means running a whole gauntlet of intermediaries that add cost and time. And as a result of this, small assets will never make it to the market at all because issuing them costs more than they're worth. So for the big institutions in the US market, the current system works fine, but it's more so these edge cases, including internationally, where it really makes a huge difference. And this would all leads to us having a fully inclusive, all-encompassing financial system.
I mean, so you pack so much into your answers. Absolutely love it. Because typically people ask for, real world examples. And I mean, you're just listing one after another. And I guess the overarching thing I'm hearing is that we're really talking about the tubes, like the nitty gritty of the financial system, how things work. And I think, we don't need to go into too much here, but there's a section in your thesis that I thought was my favorite section, which was what tokenization does and what it doesn't do. Right.
Absolutely.
And I think you've listed a lot of the things it does, but maybe just quickly some of the things it doesn't do, I thought were just as interesting. I don't know if, not to put you on the spot off your memory, I can bring up a few, but I'm curious maybe just to double click on some of the things it doesn't do.
Yeah, absolutely. So I think during that section, I wanted to make sure that people realize that it wasn't like just magic and alchemy. That basically tokenization wasn't a cure-all for everything. So like one thing it doesn't do is it doesn't create liquidity for e-liquid tokens that are off-chain. So if you're or e-liquid assets that are off-chain, if you tokenize a vineyard, for example, it doesn't necessarily mean that there's going to be huge demand for a piece of that tokenized vineyard on chain. It still works with the normal supply and demand curves that a traditional off-chain economy does. Um, it
Yeah.
also doesn't create like trust necessarily. One issue we're seeing with tokenized equities right now is that there's multiple different types that are being of equities that are coming on chain. So some of them are in an SPV, for example. Well, that doesn't necessarily create trust because you don't know necessarily what's in that SPV. You just kind of have a tokenized slice of that SPV. So
It doesn't, that doesn't eliminate counterparty risk, which is
exactly.
kind of one of the points.
Yes, and we will. I think in the future we will see more players be able to tokenize equities directly from the source, but that's not necessarily the case at this moment in time. So that's one area in which there still needs some maturation to occur. But yeah, I think it's important to note that it's not like a cure-all for everything. There's some areas in which tokenization is not, a better option than buying something off chain. However, that doesn't mean that it doesn't bring value.
Yeah, and I think that makes a ton of sense. And I want to return to that native versus kind of SPV issuance. But one thing that what you're talking just made me realize, and there's a section you have in there about the different assets. And what I've always said, and I want to know whether you agree with this, is that there's almost like a lowest hanging fruit of tokenization, and it ties into your liquidity point. Because one of our largest investments is the firm of Securitize, which is backed by BlackRock and Morgan Stanley, just listed. Um, they tried to tokenize everything under the sun,
Mhm.
experimenting in real estate and, exactly vineyards, art, all these other things, and then try to take assets and then sell those to traditional investors. And they found exactly what you're saying. That did not create liquidity, right? Just because you've tokenized a vineyard, you want to sell it, you still has to be a market for vineyards. And so what I think in my mind, the mental model I have is that it's almost like this descending, lowest hanging fruit, or I should say ascending, lowest hanging fruit. And at the bottom, you had native internet money, so Bitcoin, so tokenized internet trust, internet value, super easy. Next thing we had was actually dollars, right? So that's what stable coins are because they're completely fungible. You don't need to do any diligence. They're like everybody knows what a dollar is. So that's
Mhm.
USDT, USDC, and now a bunch of competitors that I'm sure Dave knows more about than me. Then you had treasuries, right? So tokenized US debt obligations, which is the most liquid security market in the world by far. And now we're getting to, the harder stuff, but we're starting, let's say, like S&P 500 equities, Apple, SpaceX, right? Name brands. You don't, I'm buying SpaceX because I like Elon. I don't, public filings, don't need to do any diligence. Maybe we're going to get to debt of the S&P 500. So that's kind of the mental model I have. Is
Mhm.
that do you agree with that? Is that the way you think it's going? One thing I did notice in your thesis is that you didn't include stable coins as a tokenized asset, and you just skipped them and went right to. I think we're a little different on that. I see stable coins as tokenized dollars, but yeah, so maybe just comment on that.
Yeah, no, I definitely, so that was an intentional decision to leave stablecoins out. Technically, they are a real world asset, but I feel like stablecoins are a beast in itself, and that warrants its own thesis because there's so many different types of stablecoins. There's yield bearing, there's synthetic dollars, there's genius compliant stablecoins, and a lot of people are packaging yield sourcing opportunities within stablecoins. So I decided to leave that out because I actually find like that the stablecoin thesis is already established, and that case it's already found product market fit. And on this thesis I kind of wanted to focus more on the emerging type of assets that are being tokenized. So obviously dollars went first in the form of stablecoins, and now we're seeing treasuries and money market funds, which I think are above like 15 billion right now.
Yeah.
Private credit has recently passed 20 billion in loans running through on-chain platforms, and equities are the fastest growing this year right now. And they pretty much they went from about nothing in 2025 to about 1.6 billion in issuance in roughly a year, which is pretty incredible. And I'd say that like the pattern is that standardized, liquid, yield-bearing assets go first. And there's a simple reason for it. Like a token only trades as actively as the asset that trades behind it. So dollars move the most in the Web 2 world. Treasuries are probably second. And this is why the order of adoption is kind of following in that sequence. But yeah, just generally.
You think it's easier, sorry to interrupt, but you think it's easier private credit assets to basically a collateralized bucket of loans that's paying a fee stream. You
Mhm.
think you put that slightly, let's say, because I had equities then debt, you put it slightly like easier than equities for that reason, even like a big one like SpaceX or Google or Apple or something.
So I would put it ahead of equities, and I think the main reason is there's another component of a benefit that is bestowed to tokenized private credit, in that it lowers a lot of the costs and cuts out more intermediaries than it does for equities. So for equities, the benefit of bringing them on chain is that you can borrow against them. You have more programmability, and you can use them as collateral in many
Or
different.
access, like you said, if you're outside the US. I mean, even for me living in London, like the brokerage accounts here, like, pardon my French, are absolute crap. Like, it's
Yeah.
unbelievable the restrictions. In the US, you're used to being able to buy whatever you want, basically. But, even in the UK, it's very difficult to buy the different assets that you'd like. I can't here buy a real-time S&P 500 ETF. Like, if I buy an ETF, it's like a fund where they subscribe like 24 hours. It's actually insane. So I can't like the ETF, S&P 500 goes up 10%. I can't just sell immediately. It's like, which I'm very used to in the US, obviously. So anyway, sorry to interrupt, but I just want to say access as
Yeah,
well.
no, it's true. But and just to go back about the to private credit, just tokenizing private credit, first of all, it democratizes access to a lot of investments that traditionally retail investors that aren't accredited couldn't previously access. And it cuts a lot of the costs in the actual funding process, which is why we're seeing a lot of adoption for private credit. There's just the market is enormous for one, and there's a lot of opportunities in
So
which.
on that market, so isn't private credit, I guess the reason I had equities a little easier is like let's say like the diligence like required. Like if I don't need to like look at anything to say I'm buying Apple. Okay, maybe I want to make sure it's native versus SPV, but the S&P 500 equities, they kind of this name private credit, like everything, every bundle, every loan, it's kind of like unique, right? It's different. So I guess what I'm getting at is, would the private credit market for tokenized private credit, is that a more institutional market where they know how to underwrite and they know how to manage risk? And the equities, those are more, let's say, like for lack of a better term, like retail or high net worth retail. Is that kind of the divide there?
Yes, absolutely. And then another benefit of private credit, or why it's appealing to not only institutional investors, but some, I'd say like prosumers, so not retail users, but people who are a little more sophisticated, is that it offers a diversified yield profile. So compared to a money market fund where you're only earning like 3 or 4%, for example, you can invest in a private credit fund that allocates to a tad bit riskier investments and earn 10% yield APR. So as long as you are, smart enough to actually know what you're investing in and know the risks that are involved with some of these private credit funds, then it's a really nice investment vehicle to diversify your portfolio.
And one other thing, so Securitize, I think one of the lessons of Securitize, and I have Securitize on the mind just because it went public, it is our largest holding as a firm. One of the things they learned though, I think, is that a lot of people try to tokenize things and sell it to, let's say, people in the real world. I don't know what that means, but family offices, institutions, people who aren't on chain already. And what Securitize did is they took something that was brand name in the real world, aka BlackRock Buildle, so the largest, first kind of BlackRock money market fund on chain, and they sold that, distributed it to large on chain institutions, right? So basically, trapped capital that was on chain where they don't really want to take it back to the traditional system and back and forth, and now they can earn yield from an institutional product, and that was like a massive unlock, I think, for the space. Where do you think we are? Like, do you think the big prize here is still just kind of, basically the problem there is that, as prices come down, right? I mean, total crypto value on crypto market cap was around 4 trillion, let's say, in November. Now we're down to under 2, right? So it's a shrinking pie over the last year, maybe 50% shrunk. Do you think we need to, like, is that market still big enough to foster the growth you're talking about in your thesis, or do we need to kind of, do we need the market to expand, or do we need to go outside of, let's say, like the on-chain market to regular, I mean, I don't know what the right word is, to the muggles of the financial world?
Yeah, no, it's a really good and important question. And currently in the on-chain institutional side, there's only like a handful of these big treasuries and protocols that are investing in these institutional grade assets. But I think this really is a structural shift more than just another crypto cycle. And there's two reasons why for this. The first is who's driving it. So past cycles were driven by retail investors and token prices. And this one is different. It's driven by regulated institutions putting products into production and running real volume through them. So BlackRock, for example, isn't really chasing a price chart, and neither is the DTCC. And the second is that there's three things that killed the 2017 tokenization wave that are now gone, and none of them will come back as prices fall or if they fall. There's real law in the books for one. We have a federal stablecoin framework in the US. We have MiCA in Europe, and SEC that publishes guidance instead of leading with enforcement, which they did under previous administrations. Another one is that banks are now allowed in. So because the accounting rule that blocked them, SAB 121, was repealed in early 25, it's opened the floodgates, and now traditional institutions aren't only investing in these products, but they're issuing them themselves. And then the last thing I'd say is that the infrastructure is production grade, and it's only going to get better. So we have regulated custody, reliable data feeds, transaction costs that are extremely low. So while prices will continue to cycle, I don't think the migration in tokenization will necessarily reverse with them. I think this is here to stay. And as the years go by, there's going to be increasing adoption amongst institutions as well as retail users.
I guess so. Do you see the world, I mean, to double click on that, do you see the world kind of unfolding where maybe part of the growth here is going to be, I'm a retail user on my Charles Schwab or Fidelity or Vanguard, and, everything looks the same to me, but beneath the tent, it's actually, tokenized equities, And there's some unlocks, like I can vote in ETFs or I can do cross collateral management and things. And that's how the volumes are going to come to tokenization? Or do you think it's more going to be driven by, let's say, like crypto native firms, Superstate Securitize, Ondo, Kraken? How do you see kind of the interplay between those two things on where we might, or maybe it's both? Yeah, how do
Yeah.
you see that fitting together?
This is a really good question. It's something that we've been thinking a lot about because if tokenization does accelerate at the rate in which most people expect it to, then it begs the question, why doesn't the Nasdaq or NYSE start distributing those products on a tokenized ledger, using the DTCC as the underlying settlement layer, as they do in the real world? If that market is big enough, it wouldn't make sense for them not to do that. So that's why we're kind of looking at the neutral layers that no one incumbent can own because we think long term they have the most defensible position. So the oracles, the data, these are the layers that there's not one traditional Web2 incumbent that can come in and immediately gain access and traction in that sphere. So that's why on that.
So sorry, just to double click, you're saying you think the Oracle is more, you're looking at areas where there isn't a natural incumbent that could sort of expand. Now, I mean, there is the question about whether or not these kind of old clunky institutions there's always that buy or build question. Can they build fast enough? And I just want to point out, again, full disclosure, these are both portfolio companies, but Kraken does have a uh, uh, agreement signed with NASDAQ to potentially issue tokenized stocks through its subsidiary Backed. Securitize has agreements with New York Stock Exchange and ComputerShare, the largest transfer agent, to potentially issue native for ComputerShare has more than 50% market share of the S&P 500. And then I believe DTC, is it with Canton Network that they have so I think you can kind of see these guys, they know what's coming, right? And so there are, so they could still be winners, but maybe some of these crypto companies are winners. But you're saying maybe as an early stage fund, rather than going to a crowded space, you're looking for sort of green pastures where there's nothing built.
For sure. Yeah, absolutely. I mean, I think one good example is that, you know, they're mostly not building the plumbing themselves. So BlackRock's
Yeah.
tokenized fund, for example, it carries BlackRock's name, has BlackRock's assets, but it runs on tokenization vendors' infrastructure. So the incumbents keep the brand and the customer relationships, but we think they'll rent the rails underneath. And yeah, this is kind of how we're viewing the space and think that that will continue. This stuff is
I'm gonna
difficult.
I'm gonna take that. Rent the rails.
Yeah, exactly.
That's another good tagline.
And that's kind of how we've been deploying capital in this space so far. And it's still early, so it's yet to be seen whether any of these players will build in-house. But the fact of the matter is, these institutions need to continue adopting to this new technology, for three reasons. It's like cost, customers, and defense, really. It on costs, like State Street estimated that 40 to 50% lower issuance costs for investment grade bonds. I mean, that's an incredible amount of savings. On customers, like tokenization breaches buyers that the old system just simply can't serve. So anyone with a wallet, anyone in the world at tiny minimums. And then on defense, settlement is about to become instant and global, and no one wants to be the last firm running on the old rails. So they all now feel the need to gain expertise and experiment with this technology, just to ensure that they're staying with the times and not being the slow, clunky institutions.
It's a fantastic and fantastic point, and sort of begs the question as well as these institutions come in, and obviously these are highly regulated financial markets, particularly in the U.S. And again, I think our conversation is sort of without really stating it, focused on the regulated markets, U.S., Europe, and really predominantly the U.S. These highly regulated firms, without getting too in the weeds, but there is this kind of two sides, let's say, of blockchains, and it's not exactly neatly divisible, but we have sort of permissionless, public, open source blockchains, a la Ethereum, Solana, potentially, and many others, where anybody can use them. There's not KYC, there's no, restrictions whatsoever. And then we have sort of the world of permission blockchains, which has been, a trend that has come and died, 4 or 5 times in crypto, but seems to be coming back in vogue. Um, where do you see these two things fitting together? And I would note, I think BlackRock's Buildo Fund and did a launch on Ethereum initially before expanding to about 15 other chains. albeit in a sort of whitelisted, controlled environment done by Securitize. But how do you see, and this relates to kind of my next question, but how do you see the those two potential avenues playing out in the space? And I know it's a big topic. Canton is now very highly valued, kind of
For sure.
more of the private permission blockchain. And again, for the people in the audience, basically what that means is it's sort of a almost like a consortium or a basically where a bank could come in, have a blockchain of all the benefits of a blockchain, but not really achieve true decentralization where no one player controls the network. You either could have one single entity actually control the network still, or you could have a consortium, 10, 15, 20, 1,000, but like sort of whitelisted, selected participants, maybe all the banks go in together or something like this, as we've seen with the recent stablecoin announcement. But how do you see that playing out?
Yeah, so it's a really good question, and it's interesting because with these private permission blockchains, such as Canton, for example, you have all these big name institutions that are signing up. However, there's no retail volume that's flowing through Canton Network right now. Most of the volume that they're seeing, which is pretty extraordinary, is record keeping and backends amongst big financial institutions. So it kind of serves a different use case. And we're seeing a lot of players now deploy on several different chains. I mean, that's the one thing that's good about public permissionless blockchains is that they're all interoperable with each other. So if you deploy an asset on Ethereum, you can easily move it to any other EVM compatible chain. And the universe of retail users is much larger because currently all of the retail users are on public permissionless blockchains. So it's a much bigger market. But there's definitely, I think there's a world in which both will succeed. They just will serve different use cases. And, we're still yet to see, we've spoken with a lot of teams that are building on the Canton ecosystem. Most of them are catered towards institutional use cases. One thing we haven't seen is whether institutions are going to only use Canton as a record keeping chain or if they're actually going to be deploying capital within the applications on the chain. And that's different from the public permissionless blockchains in which retail users are actually using the protocols that are deployed on these blockchains and interacting with each other, making more microtransactions. So it's yet to be seen how this will play out. But as of today, I'd say that these private permission chains have not been very appealing to retail investors and use cases.
Yeah. I get the other point I would add maybe to that is even for the institutions, there's this question of provable neutrality, which I think is really interesting, which is so if I'm, JP Morgan and we can, because there's this idea we haven't really talked about, which was notably absent in your thesis, which is tokenized deposits, right? Which is, basically you could tokenize a bank deposit. And there's a big debate between those and stablecoins, what's more valuable. But one of the problems that tokenized deposit has, and I think it's sort of indicative of this broader problem of closed systems, is that why, if I'm Bank of America, if I'm Goldman Sachs, would I do anything on the tokenized deposit of JP Morgan, my competitor? Why would I build on their system? Why would I build on their permission blockchain? And so that's, I think Ethereum still today, it has a lot of, kind of issues, I think, that are going through the crypto community. But it still is the largest venue for tokenized assets. And I think one of the reasons is that, BlackRock can launch there without saying, this helps Vanguard, this helps Fidelity. It's a neutral system. And so I think that idea of provable neutrality is actually super interesting.
No,
Um,
absolutely. No.
and so we're coming to the end here. I know we just had 45 minutes. I want to go full circle back to the original question. I mean, the end of this conversation has been incredibly institutional. I mean, we've talked about BlackRock, we've talked about all these different players. And at the beginning, you said, you got into this because you were fascinated with decentralization. And it is starting to feel, for better or for worse, and that's where this is going, that this has become a very Wall Street led process. And I guess I just want to ask you, how do you feel about that? Do you think that that's a good thing? Do you think that maybe an out of favor currently part of the system, which is decentralized financial systems, could come back into favor? I'm asking you to speculate a little bit now, but
Yeah,
how do you feel about all this? Now that we're not really,
absolutely.
we're talking about tokenizing assets with BlackRock. We're not talking about, decentralized, lending pools that don't have any institutional
Sure.
name on the front.
No, and it's funny because a lot of the original crypto purists now feel ostracized by this maturation of the industry and that the big institutions have now arrived. But at the same time, this is what we had always asked for when the crypto was starting up. If you were to tell me that DTCC, like Nasdaq, all these BlackRock, all these companies are now adopting crypto, they were all adamantly against crypto 5 years ago. And if you were to tell us that they would be building on chain, we wouldn't have been able to believe it. So while price, I think a lot of the crypto purists as well are upset that over this past cycle, prices haven't really appreciated much. But that doesn't mean that a lot hasn't happened in the industry. If anything, this has been a period of extreme growth, and that is breached into the mainstream. So I think at the end of the day, if crypto was to ever succeed from its time of inception, it would need institutional adoption, and we've reached that stage. I just think it's kind of left a lot of the early crypto players a bit ostracized and a bit out of their territory. Crypto is now converged into more of a traditional industry. It's no longer, you can invest in a startup, they release a token a couple months later and it has a multi-billion-dollar valuation. It's more conforming to the traditional venture world where you need to be more diligent in evaluating founders. The bar is a lot higher. And I think overall this is good. It just shows growth and maturity. And I think this acceleration will only continue as more players begin to build and experiment on chain.
Very well said, and could not agree more. I mean, I think we set out to change the financial system. I mean, blockchains at their core were always a financial technology.
Yeah.
There's other use cases, but the sort of simplest, most applicable is always going to be related to money, related to transactions, trading, and finance. And, the only way to change the financial system is to have involvement from the institutions, just given the, political economy dynamics.
Absolutely.
So I think I completely agree. I think it's absolutely a good thing. I would say that I also think that some of the most interesting things ever built with software have come out of the DeFi space. I mean, to me, it's so absolutely fascinating that you can go get a loan from an open source software contract. I mean, it's, which would be companies like Aave or Morpho or Compound, where you use basically software to create a lending market, a money pool. And same with, Uniswap and many other really interesting experiments that were built and protocols that still function, very well today. So I haven't taken my eye off that space because I think there still is, I want to live in a world, I think, where you have sort of, depending on what you would want to do, you can either go into your bank and get a mortgage. I'm going through the process now in London. I'm going to get a mortgage from a what they call a high street bank here in London. That's what I want to do. But I want there to be an option to do a mortgage from a decentralized network because I think that that's quite interesting.
Absolutely. No, the programmable nature of blockchain technology is something that is very underrated. And while DeFi has already produced tons of new innovation, I think this is just only going to continue, and that DeFi will be the ultimate beneficiary of tokenization down the line. Just because the biggest benefit of bringing assets on chain is the fact that you can use them in various different ways without all these middlemen at the speed of light. And yeah, that's the power of software. And that's why I think more and more people will realize, especially in an increasingly digital world, that this is the path forward.
Very well said. Well, David, thank you very much for joining us. For anyone who's interested in speaking with you or in learning about 1KX or any of its funds or investments, if they want to reach out to you, what's the best way to get in contact with 1KX?
Yeah, absolutely. So first of all, our website is 1kx.capital if you want to read some of our team's theses and writings. And yeah, you can also just reach me on LinkedIn, David Alamany. I'm always happy to chat and build my network out in the crypto space. So yeah, thank you so much for having me, Mitch.
Of course, David, thank you so much. And again, at Fifth Era, we've invested in more than 35 fund managers across 6 different fund of funds, blockchain and AI. 1KX has been one of our, let's say, best friends in terms of a underlying investment firm. So we couldn't be happier with the relationship with 1KX, not investment advice. And on top of that, we also do direct investments and many of the names talked about today. So really appreciate you joining. If you want to reach Fifth Era, you can always email us at ir@fifthera.com. And be on the lookout for future webinars covering various topics in technology. So thanks so much, everyone. And thanks again, David, for joining.
Thank you.